Today is all about the moving average. So data analysis about moving average. So before we do it in Excel, we have to define first what is a moving average. So what is a moving average in financial technical analysis? So normally, um, it is the simplest form of a moving average is applying the arithmetic mean of values shown as lagging on a chart. So when we say arithmetic mean, you are going to get the average per day on a certain period. So most traders normally are using retail and oversimplified methods tend to use moving average crossovers to signal chart reversals. So it really just measures the changing of a market's price relative to time with a slight lag. So if you are going to put it in a graph, the market price is on the left side and then the time is on the bottom side or the or the x-axis. So it can be used with moving averages of other time frames to signal entries and exit. So it is normally calculated by adding together the prices over a set period of days and then dividing by the number of days over which this is measured. So if you are going to remember your statistics, I think this was discussed. It was not discussed as a moving average, but I think it was discussed as an arithmetic mean of a certain period. So it is slightly logged, though, as we will see upon further inspection in a moment. Normally, traders or financial brokers, since you are accountancy, so you should be able to be familiar with a moving average. So traders normally use this method. They can often be over reliant on a simple indicator that can, of course, work in some cases but has an insufficient accuracy level and, as such, isn't something the professionals favor. So let's go back to a quick review on how we normally do a simple moving average in statistics. So the first step that you normally do to find the moving average is you have to find the average of a number of prices. For example, you can calculate the average of 10 prices for that certain day. Then the next day, you will need to add the newest price to the total and subtract the oldest price, keeping the total number of prices constant at 10. So we will not review the computations anymore because our subject is all about is statistical analysis using data. So which means you should be able to have the foundations on your previous subjects before you move forward to this one. So this one is just a simple review of how you normally do it, but our subject would normally focus on how you are doing it in a software, specifically in Excel. So I'm just giving an overview to give you an avenue to remember what was discussed to you before on your previous subjects, which is statistics. So the standard simple moving average uses the close because the close is the summary of the period's action and sentiment. Then the third step is you calculate the average of this set of prices. Then the last step is you are going to repeat this calculation for every new price. So every day, if there is a new price, you are going to add it to the previous one and subtract it to the old price. So this normally how a graph of a moving average looks like. So as you can see, we have here August, September, and October and November. This is called the period. And these are the average of the prices. The this one here. So as you can see, every period you are going to plot the average here. So you are going to see if it's moving up or moving down. So here is a sample table of gains and losses following the moving average crossover in a trading rule. So hypothetical profit from the simple moving average crossover rule. So we have number of days, so 19 days, 14 days, 2 days, 28 days, 38 days, and then the total. So normally, if you're going to put it on a ledger, it's gonna be you are buying it for this price and then you are selling it for this price, $76. And then your crossover profit is 5.39 if you're going to subtract 76 to 7.61. So the buy and hold would be $70.61 and so on and so forth until the other days, and then you will have a total of $26.09, which is 37% of the crossover profit. So the moving average, or we can call it MA for short, is probably the most popular trend following indicator used by forex traders. So how do you normally use it in forex? So in simple terms, a moving average reflects the average closing price of a market over a specific number of periods. So the number of periods, which is the number of days earlier, is called candles. So you can also base it on an opening of a candle, high or low, but usually the closing price is used. So in this graph here, same as what I've mentioned on the previous graph, this 20 period MA, or written as MA quantity 20, on this daily chart reflects the average closing price during the last month. So the last month, it will have a 20 working days or candle, which is our period. So the moving average primary use for trend identification and analysis. When we say trend identification, we would be able to see in the market which one do we need to invest to. So which market trend we need to go on to. So if MA is rising, we call it uptrend. And if MA is falling, we normally call it downtrend. So MA is turning, trend may be ending. If MA is normally flat, the trend is weak. If MA is steep, normally the trend is strong. So the secondary usage of moving average is to define the areas where price may encounter support or resistance. When we say support, it's actually the company that supports another company, or a resistance. What are the factors that normally considers a negative effect on the trend of your market price? So in this relatively strong uptrend, since it's going up on a weekly chart, um, the support is evident or around the popular rising of MA50. So normally, popular moving average settings, weekly, we have moving average of 50. In a daily basis, we can get moving average of 20 or 200. Intraday, we could get MA of 4, MA of 9 or 10, MA of 18 or 20, or MA of 40. So normally, higher value MAs are classed as fast MAs, and lower value MAs are classed as slow MAs. So as a conclusion, it's too simple. Certainly, moving average are useful, but as a means to an end are insufficient. So they have a low accuracy but can be correct. So as traders, we want to capitalize as many opportunities as possible. So moving averages are only correct a very small amount of time. They can be tough indicators to combine stop losses with or specific exit points, as they are slightly lagged. Overall, perhaps a useful tool for momentum but insufficient for using in a long term strategy and over a broad range of asset or classes. So now we move to our next topic, since that's only a review about moving average that was discussed to you on your previous subjects. So now we will move on to the proper topic that we have. So how do we normally do moving average in Excel 365, or Excel 2016. So let's say, for example, we will have a series. So we will have a period from 0 to 11. So it's this is we can tag this as month 0, where we started, up to 11th month, and then the actual averages are 120, 150, 240, 540, 210, 380, 120, 870, 250, 1100, 500, and 950. So as what we are doing before on our previous topics, what we need to do first is we have to go to the data tab in the data analysis toolpack, and then you have to select moving average and then press OK. Then you have to click the input range box and select the range. In our example, the range is B2 up to M2. So from B2 up to M2. So that's our input range. And then the next step that we have to do is to click in the interval box and you have to type 6, because our interval is 6. And then you have to click in the output range box and select B3. So if you're going to go back there, so you are going to select B3. That's where we are going to show the result. And then after you put the input range, interval, and the output range, you can now press OK. And then after this one, we can actually plot a graph of the values that we have. So this would be the normal result of our plotting if we are going to plot the first values. And then we just have to repeat steps 2 up to 8 for for interval 2 and then interval 4. So we have three intervals here, 2, 4, and 6. So now we will try to do it in Excel. Just going to open my Excel. Okay, so let's assume this is our Excel. So we are going to put our values here. Okay, so now this example normally teaches you how to calculate the moving average of a time series in Excel. So a moving average is used to smooth out irregularities. So irregularities can be represented by peaks and values to easily recognize the trends that we have. So first, let's take a look at our time series, just like what we mentioned earlier. So if we are going to take a look, we have periods from 0 to 11, which is located in B. 1 up to M M1. And then we have the actual values located in B2 up to M2. So for us to be able to start our data analysis using a moving average, first we have to click data here, and then we have to click on data analysis. And then we have to look for the moving average, which is this one. And we have to press OK. So after pressing OK, we have to click on input range. Then we have to select B1 up to, B2 up to M2. And then we have to put an interval of 6. And then on the output range, we have to select B3. And then we press OK. And then we have to plot the graph. So what we need to do next is to repeat these steps and the procedure. So you have to get the values for the other interval. Okay, and we have to do this as 4. Okay, and then we have to do it as well for the interval 2. Okay. So since we have now the complete intervals that we actually ought to have based on our objectives, now we are going to plot the graphs. So if you're going to plot them, this would be the result. So as you can see, the blue ones on the legend is our actual trend. Our interval 2, so this one is for interval 2, the orange one. Sorry, I'm actually colorblind. This one is for interval 4. And then we have not sure about the color. I think it's yellow for interval 6. So how do we interpret this one? So how do we normally interpret this one? The larger the interval, the more the peaks and valleys are smoothed out. So the smaller the interval, the closer the moving average are to the actual data points. Okay, so our conclusion, the larger the interval, which is our largest interval is 6, the more the peaks and the valleys are smoothed out. So let's look on interval 6 again. So this is interval 6. As you can see, from the actual one, which is like this one. So when the intervals become lower, the our lower here is the actual one. So when the interval becomes lower, the trend actually becomes uglier too. So as you can see, it's not that smooth compared to a high interval value. So because we set the interval to 6, the moving average is the average of the previous 5 data points and the current data point. As a result, fixed and values are smoothed out. So the graph normally shows an increasing trend. So Excel cannot calculate the moving average for the first 5 data points because there are not enough previous data points compared to the last 6 here. So as you can see, the higher the interval or the lower the interval it gets, we are actually getting a value here because of our previous history of the data. So if you're going to do a study, if your study is related to market prices, so if you're going to prove which market price you can get, you can actually use the moving average to actually compare the different market trends. So if you have four options like this one, let's say for example, the blue one is the trend for Jollibee, the orange one is the trend for McDonald's, the other one is for KFC, and then the interval 6 is for let's say Pizza Hut. So if you're going to invest to to a company, you are going to invest to the one that has a smoother trend, which is the one on the interval 6. And in our example, it could be Pizza Hut. So that's actually the usage of a moving average. If you're going to study not just market trend, it's also applicable to market prices for different products. If you're going to sell products and you're studying which one would be a bestseller, so you also can use this tool to check which one would be the best choice if you are going to sell something.